There is a math problem that has been sitting at the center of American retirement for more than a decade. Congress has known about it. Both political parties have known about it. Multiple administrations have known about it. The problem has been studied, reported on, projected, and discussed in every possible setting, and until yesterday, almost nothing had actually been done. Yesterday, the 14th of July, 2026, a bipartisan group of 8 senators introduced a bill specifically designed to force Congress to vote on fixing it. For the first time in years, there is a concrete piece of legislation with a defined process and a required vote attached to it. This video is the plain English explanation of what that bill does, what the math behind it actually says, and what it realistically means for the check you receive every month. 2 things most coverage of this topic gets wrong, and that I want to correct before we go further. First, most coverage presents the trust fund depletion date as if Social Security checks stop entirely on that day. They do not. Second, most coverage presents proposals like the one introduced yesterday as if they are already law. They are not. This video gives you the accurate number and the accurate status of where things actually stand right now. My name is Mason Parker. Subscribe right now and turn on the bell. This channel covers these rules in plain language every single day. Hit subscribe and let us get into the math. 3 things to hold through this video. First, the reason the depletion date moved 1 year earlier in this year's report surprises most people. It connects directly to a law that was supposed to help seniors. Second, the 22% cut that everyone is talking about translates to a specific dollar amount per month, and most people have never seen that number clearly stated. Third, there is one specific step that protects your retirement income regardless of what Congress ultimately does or does not do, and it is available to you right now. Let us start with the math because the math is what everything else in this video is a response to. Every year, the Social Security Board of Trustees releases an annual report on the financial condition of the program. The 2026 report released in June projects that the Old Age and Survivors Insurance Trust Fund, which is the fund that pays retirement and survivor benefits, will be depleted in the 4th quarter of 2032. That is 6 years from right now. That date moved. Last year's report projected depletion in 2033. This year's report moved it 1 year earlier to 2032. In a moment, I will explain exactly why, because the reason matters. First, what depletion actually means, because this is the piece most coverage gets wrong. Depleted does not mean the program shuts down. Social Security collects payroll taxes from every working American every single paycheck. That revenue does not stop when the trust fund runs out. What stops is the ability to supplement current payroll tax income with the reserve savings that have been building inside the trust fund for decades. After depletion, the program continues paying benefits from ongoing payroll tax revenue alone. The trustees project that revenue would cover approximately 78% of scheduled benefits at that point. The other 22% would be an automatic across-the-board cut unless Congress acts before 2032. Now, the specific dollar number that most discussions leave vague. The average Social Security retirement benefit in 2026 is $2.71 per month. A 22% reduction on $2.71 is approximately $456 per month. Not a small adjustment, not a rounding error. $456 per month less in every retiree's account. For a couple both receiving Social Security, that cut doubles. The Committee for a Responsible Federal Budget, a nonpartisan fiscal policy organization, estimates that if no action is taken, more than 3 million additional seniors and people with disabilities would be pushed into poverty solely as a result of that automatic cut. Now, the reason the date moved 1 year earlier because this connects to something most seniors never expected. The One Big Beautiful Bill Act, signed in 2025, included a provision that increased the standard deduction for seniors and added the new $6,000 enhanced senior deduction for taxpayers 65 and older. Those provisions reduced the federal income tax that Social Security beneficiaries pay on their benefits. Here is the connection most people missed. A portion of the federal income taxes that Social Security recipients pay on their benefits flows back into the Social Security Trust Fund as revenue. When seniors pay less in income tax on their benefits because of the OBBBA deductions, less tax revenue flows back into the trust fund. The program collects less income, the trust fund balance builds more slowly, and the depletion date arrives 1 year sooner. The OBBBA was designed to help seniors financially, and it does. The $6,000 deduction is real and valuable, but the trustees' report identifies it as one of the reasons the depletion date moved. A provision that benefits seniors today is contributing in a small way to the pressure on the program's long-term finances. Both things are true simultaneously. The deeper cause of the funding gap is not any single piece of legislation. It is a structural change that has been building for 60 years. In 1960, there were 5 workers paying Social Security payroll taxes for every 1 beneficiary receiving benefits. That ratio has declined steadily as the population aged and birth rates fell. Today, the ratio stands at approximately 2.9 workers per beneficiary. The trustees project it will drop further to 2.2 workers per beneficiary by the 2070s. The payroll tax that funds Social Security is levied on earnings up to a specific taxable maximum. In 2026, that maximum is $184,500. Earnings above that amount are not subject to Social Security tax. In 1983, when Congress last reformed Social Security, approximately 90% of all wages in covered employment fell below the taxable maximum and were therefore subject to the payroll tax. Today, that figure has dropped to 83%. Higher income earners have seen faster wage growth over the past 40 years, which means a growing share of total wages now falls above the cap and escapes the payroll tax entirely. The 75-year funding gap for the program rose to 4.4 to 42% of payroll in this year's report, up from 3.82% the year before. The Committee for a Responsible Federal Budget described the financial outlook as having substantially worsened. Social Security has not collected enough payroll tax revenue to cover all its expenses in any year since 2009. The trust fund balance has been absorbing the gap. In 2032, if nothing changes, the cushion runs out. That is the math. 6 years, 22%, $456 per month. Now, what Congress is actually doing about it and what the bill introduced this week would and would not change. The bill is called the Promise Act. The full name is the Protecting Retirement Opportunities and Maintaining Income Security for Everyone Act. It was introduced yesterday, July 14th, by 8 senators from both parties: Bill Cassidy of Louisiana, Dick Durbin of Illinois, Tom Tillis of North Carolina, Tim Kaine of Virginia, John Cornyn of Texas, Angus King of Maine, Chris Coons of Delaware, and Alan Armstrong of Oklahoma. Here is the first thing to understand about what this bill actually is. It does not itself raise taxes. It does not cut benefits. It does not change the retirement age. It does not alter eligibility rules. It does not fix Social Security's finances. What it does is create a process that would require Congress to vote on a plan that does those things. The mechanism works like this. The Social Security Advisory Board, which is an existing independent bipartisan advisory committee, would be directed to develop a base bill designed to keep the Social Security Trust Fund solvent for at least the next 50 years. That base bill would then be brought to the floor of both the Senate and the House for a required vote through a fast-track procedure. The Senate would need a 3/5 majority to pass it. The House would need a simple majority. Members could offer substitute amendments, but any amendment would also have to ensure solvency for at least 50 years. The bill also creates a 10-year automatic trigger. Every decade, if a Social Security funding shortfall is projected, the same floor procedure would activate again, ensuring the process repeats rather than requiring a new political effort from scratch each time. What the Promise Act is, in the clearest terms, is a mechanism to prevent Congress from continuing to avoid the vote. It does not predetermine what the fix looks like. It forces a decision. Multiple proposals already exist that a Promise Act process could bring to a vote. Understanding them is the reason the title of this video says the details surprise you, because the options on the table are more varied than most people realize. The first category involves revenue. Raising the payroll tax cap is one of the most discussed options. Currently, earnings above $184,500 pay no Social Security tax. In 1983, the cap captured 90% of all wages. Today, it captures 83%. Raising the cap or eliminating it entirely would bring more income into the system. Senators Warren and Moreno published an opinion piece in the New York Times in June specifically calling for this approach. Americans for Tax Reform, led by Grover Norquist, organized significant conservative opposition to this idea, illustrating how contested even this one option remains. The second category involves benefit adjustments. One proposal, called the six-figure limit, would cap Social Security benefits so that no couple can receive more than $100,000 per year in combined retirement benefits. The Committee for a Responsible Federal Budget estimates this would contribute meaningfully to closing the solvency gap while affecting only the highest-earning retirees. A separate approach would modify how cost of living adjustments are calculated, which would slow benefit growth over time. The third category involves structural changes. Senator Cassidy has separately proposed establishing a sovereign wealth fund where the government invests a portion of funds in higher yield assets rather than holding them only in treasury bonds. Another proposal would gradually increase the full retirement age beyond 67, reflecting longer life expectancy since the last reform. Any of these options or some combination could become the plan that a Promise Act process ultimately produces. What makes the act unusual is that it does not prescribe the answer. It simply ensures the question gets a vote. Congress has been here before. The parallel that matters most to understanding where things might go is 1983. By 1982, the Social Security Trust Fund was weeks from being unable to pay full benefits. The political conditions were similar to today in one specific way. Both raising taxes and cutting benefits were politically toxic, and neither party wanted to be seen as the one that did either. President Reagan appointed a commission led by economist Alan Greenspan and gave it a specific mandate: find a solution both parties could agree on. The Greenspan Commission produced a set of reforms that included raising payroll taxes, gradually increasing the full retirement age from 65 to 67, beginning to tax Social Security benefits for higher income recipients, and expanding coverage to new federal employees. Congress passed the reforms and Reagan signed them. The result was a program funded for the next several decades, which is why the trust fund has had reserves to draw from all the way to 2032. The difference between 1983 and 2026 is the level of political urgency. In 1983, the fund was weeks from failing. Today, it is 6 years away. The Promise Act is an attempt to create a process that forces action before the crisis is immediate, rather than waiting until it is. Whether Congress will move on the Promise Act itself, on one of the other proposals already in circulation, or on some combination remains genuinely uncertain. Several previous attempts to create commissions or special processes for Social Security reform have not gained enough traction to produce a vote. While Congress debates Social Security's long-term math, the present issues affecting your monthly check are different and fixable right now. The IRMA surcharge running on income you stopped earning. The earnings record error quietly reducing your benefit, and the W-4V withholding fix that stops you from sending the IRS your own money 12 months early are all in the Senior Money Defense Playbook. Every form, every phone number, every step link in description, or scan the QR code on your screen right now. Congress introduced a bill this week. The trust fund depletes in 6 years if nothing changes. The 22% cut equals $456 per month on an average benefit. That is the situation. Now, the question that actually matters for the person watching this video. What should you do differently because of it? The answer is more specific than most coverage suggests and less alarming than most headlines imply. The first thing to understand is the planning timeline. 6 years is not 6 weeks. It is not 6 months. The seniors most directly affected by a 2032 depletion date are people who are currently in their mid to late 60s and who will be collecting benefits continuously through 2032 and beyond. If you are 68 today, you will be 74 in 2032. If you are 60 today, you will be filing for Social Security sometime in the next few years and collecting through 2032 and likely well past it. For people who have not yet filed, the 2032 date does not change the core claiming math in any simple direction. The question of whether to claim at 62 at full retirement age or at 70 still depends primarily on your health, your other income sources, your spouse's situation, and your break-even calculation. Claiming early out of fear that Congress will cut benefits is not a strategy. It simply locks in a permanent reduction on whatever benefit Congress ultimately decides to pay. If Congress acts and preserves full benefits, you will have accepted a permanent reduction for no reason. If Congress enacts a partial cut, you will be receiving a permanently reduced share of that already reduced amount. The rational response to uncertainty about future benefit levels is not to lock in a lower amount permanently. It is to understand what your full benefit would be at each age and make the timing decision based on your actual financial picture. The second planning consideration is income diversification. The senators who introduced the Promise Act framed it as a way to prevent an automatic 22% cut. The honest assessment is that some adjustment to Social Security's finances is mathematically certain between now and 2032. Whether that adjustment comes through the Promise Act, through another piece of legislation, through a combination of proposals, or through an across-the-board cut if Congress does nothing. The form that adjustment takes and who bears it is genuinely unknown. What is knowable is the degree to which your retirement income depends on Social Security specifically. A retired couple whose Social Security covers 80% of their monthly expenses faces a different level of exposure than a couple for whom it covers 30%. The practical implication is not to panic about Social Security, but to ask honestly whether your income structure gives you flexibility. If the benefit structure changes, Roth accounts, HSA balances, and non-retirement investment accounts generate income outside the Social Security system entirely. Traditional IRA distributions are taxable but independent of the benefit calculation. The retirement planning principle that applies here is the same one that applies to any financial uncertainty. Concentration in a single income source is the risk. Diversification across sources is the response. The third consideration is the earnings record. Every dollar of your eventual Social Security benefit is calculated from your earnings history. If that history contains errors, every year of undercalculation costs you a permanent percentage of your monthly benefit. A single missing year can reduce your monthly check by approximately $100 permanently. Over a 20-year retirement, that is $24,000 in lost income from one uncorrected error.
If Congress does ultimately adjust benefits, you want the starting number from which any adjustment is calculated to be as accurate as possible. A benefit calculated on an incomplete earnings record produces a lower starting point. A correction filed with Form SSA 7008 before Congress acts restores the correct base. The correction process is free. The form is at ssa.gov. The window to file is open right now. Your action steps. Log into ssa.gov and check your earnings record. Confirm every year reflects what you actually earned. Look specifically at your highest earning years and at years when you changed employers. If you find an error, download Form SSA 7008. Sign it in ink and mail it by certified mail to your local Social Security office. If you have not yet claimed Social Security, do not change your claiming timeline based on fear about 2032. Run the 3-number comparison, your estimated benefit at 62, at your full retirement age, and at 70.
Make the decision based on your health, your income needs, and your household picture. If you are already collecting, the number that changes between now and any legislative action is 0. Your benefit is set based on your earnings record and your claiming age. What Congress decides will apply to whatever base benefit you are receiving at the time. Protecting the accuracy of that base through an earnings record check is the one proactive step available to every current beneficiary. Mark 2032 on your calendar, not as a deadline to panic about, but as a date to watch. The Promise Act was introduced yesterday and referred to the Senate Finance Committee. What happens next in that committee, whether a floor vote occurs, and what the final legislation looks like, will be worth following as it develops. The math has been known for a decade. The political will to act has been the missing variable. Yesterday's bill is the first concrete attempt in years to create a mechanism that forces the vote. Whether it passes, whether it produces a plan, and what that plan ultimately contains are genuinely open questions. What is not an open question is what your earnings record says right now, what your estimated benefit is at each claiming age, and whether the income structure you are building for retirement depends too heavily on a single source whose future contains real uncertainty. Those are the things worth acting on before the next trustee's report arrives. The Social Security Earnings Record Correction, the IRMA appeal, the provisional income formula, and the bank account rules that protect what you receive are all in the Senior Money Defense Playbook. Every form, every number, every step. Link in description or scan the QR code on your screen right now. Subscribe. This channel covers these rules every single day in plain language. Share this with one person you know who has heard about the 2032 date and assumed it meant their checks were stopping. The math is more specific than that, and so is the response. I will see you in the next.